Hey guys, Brad Bob here today with Bob Financial, and I want to go through 3 year-end tax planning ideas for you. Okay, there's a lot of things you can do here at year-end, and there's more tax planning things you can do than these. But for sake of today's, just to make it a shorter video, we're just going to go through 3 ideas. All right. So these are my top 3 ideas here for the end of 2024, and number 1, QCDs. Okay, what is a QCD? Qualified Charitable Distribution, all right? And what is that? How does it work? If you are age 70 and a half or older, you have money in an IRA, then you can gift money directly from that IRA to a qualified charity, okay? And now, why? Why would you want to do that? Why is that beneficial? Well, because money in your IRA is tax deferred, correct? Meaning you have not paid any taxes on that money. Therefore, when you gift that money to a charity directly from your IRA, if it's, say, $10,000, that $10,000 goes directly to the charity. You don't pay any income taxes on that money, okay? So it's a way for you to take a distribution from your IRA and not pay any taxes on it. Most people that gift charities out of cash, okay? Just their bank account, their income, whatever it may be. Well, you could take that income and invest that money and have a high basis, and then take the money from the IRA to give to the charity, okay? Save you some tax money. If you're in a 12% tax bracket, you gift, say, $10,000, it saves you $1,200. If you're in a 22% tax bracket, it saves you $2,200, all right? And that's just in federal taxes, okay? That's not mentioning state taxes. Every state is different, but it could save you some money there as well, okay? Then the other thing I have listed here under that, as far as gifting a charity, one last thing about QCDs, that money can also, so you can do that once you turn 70 and a half, then once you're RMD age, where you're taking required minimum distributions, that money can apply towards your RMD, okay? So there's a lot of benefits of that. If you're taking money out of your IRA, that also reduces future RMDs if you start doing that at 70 and a half. A number of benefits to doing a QCD. Moving on, but you have to be 70 and a half or older to do that and have money in an IRA. That can't be done from TSP. Gifting appreciated assets, okay? Who can do that? Anybody can do that, all right? And as far as gifting appreciated assets, it applies to more than just securities, but if we're talking about investment securities, if you have a brokerage account, you've invested money in a stock or a mutual fund or an ETF that you have held for 12 months or longer, then you can gift that position directly to a charity and then not pay any taxes on the appreciation of it. You still get the deduction. Okay. Now, a lot of people don't get the deduction, doesn't do them any good when they do their taxes anymore because the standard deduction is like $29,700 for 2024, I believe. So most people don't get any benefit from gifting to charities anymore, or at least married couples. It's easier for an individual, but you do still get that deduction if you're able to take that. But if you're gifting money to a charity, say you've had a position in a stock for 10 years and it's grown from $2,000 to $10,000, and you gift that whole position of $10,000, you don't pay any taxes on that $8,000 of gain, the difference between the 2 and the 10, okay? So that's gifting to charities, all right? And if you're doing that, make sure you get that started a couple weeks before year end to make sure it's done by year end. All right, number 2, conversion. Roth conversions, I talk a lot about conversions. Sometimes they're a good fit, other times they're not. It's something for you to look at, okay? And this is gonna be most applicable to those of you that are retired, okay? Maybe you're retired and everybody finds themselves in a different situation, okay? Maybe you're age 63 and you got your special retirement supplement up to the age of 62, it stopped, and you're delaying Social Security. Well, your income may be lower for a period of years until you start collecting Social Security. Maybe you want to do a conversion this year. Or maybe you are collecting Social Security already. It may still make sense to do a conversion, okay? Figure out what income tax bracket you're in, what income tax bracket you're going to be in next year, 5 years from now, 10 years from now, what income tax bracket your beneficiaries are in. Are you going to need to take your full RMD when you turn RMD age? Are you going to be taking those full distributions? Are you going to need that as income? Okay, or are you not? Are you just going to pay taxes on that money, take it out and reinvest it? Okay, there's all kinds of factors that come in here when it comes to Roth conversions, but good idea to look at, especially if you're retired. Okay, it may make sense for you to do, and I'm not saying it makes sense to convert your entire account. Like if you have an IRA with 500,000 in it, probably doesn't make sense to convert that whole thing, but it might make sense to convert 15,000 of it or 50,000 of it. Okay, so look at your Roth conversions, see what tax bracket you're in, see what tax bracket you're going to be in the future. Does it make sense to do today or doesn't it? All right, now doing that, you also want to pay attention to IRMA, okay, surcharges on Medicare. If you are collecting Medicare, that's based on your income from 2 years prior. That could push you up into a higher bracket there to cost you more on Medicare. And maybe it still makes sense to do a conversion, but then again, it may not. Just be aware of what you're doing there. It also may cause you to have a higher effective tax rate, okay? If you're in a lower tax bracket and you're collecting Social Security, it may cause more of your Social Security to be taxed. So, number of things to look at. Number 3, tax gain harvesting, all right? Tax loss harvesting is something people talk a lot about. I've talked about it as well. But tax gain harvesting is something that's forgotten a lot of times, okay? And what I'm talking about here is go back to appreciated assets. You have a brokerage account, you have a mutual fund or a stock that's appreciated, all right? Now, if you've held that position for 12 months or longer, you're going to pay long-term capital gains on the gain of that position when you sell it, all right? Now, you pay taxes on long-term capital gains differently than you do on ordinary income, all right? Tax brackets for long-term gains are 0%, 15%, 20%, okay? The 0% bracket is if you are in the ordinary income brackets of 12% or lower. So if you find yourself in that 12% income tax bracket and you're to stay in that bracket, then you would pay 0% on your long-term capital gains, okay? So if you are in a position there, it may make sense for you to sell a position to harvest a gain, and then you may want to buy that position right back, and what that does is that just increases your basis, okay? So, and again, you want to pay attention to everything, okay? You could have state income taxes when you do that. When you harvest a gain. So maybe you won't end up paying 0%. Maybe you'll pay some kind of taxes on state taxes, but yet your federal could be 0%. All right. Lots of moving parts here, but those are my 3 ideas for the end of 2024. Gifting to charities. So qualified charitable deductions or appreciated assets. 2, conversions. Look at doing a conversion this year. See if that applies to you. It may not, or it may. And number 3, look at tax gain harvesting. You may want to harvest a gain, okay? It may save you some taxes in the future. You may pay nothing on it today, increase your basis. Okay, guys, Brad here, Bob Financial. If you like the video, please thumbs it, share it, help me spread the word. Thanks a lot.